Solomon Floyd. I started Reunion Investments about 5 years ago, and we've been working to build up small tertiary market communities and provide housing to those in need around the country. So our main focus has been areas in places like Wichita Falls, Texas, Burke-Burnett, Texas. We're looking in Lawton, Oklahoma, Baltimore, Maryland. We're in Panama City Beach, Florida, soon to be in Minot, North Dakota. We're about to start branching out to California as well. So Reunion Investments as a company itself, we're about 10 people strong. We love doing what we do, and we're glad to have everybody here. So just a brief overview of sort of where we're coming from with all this is the idea is, breaking down a deal in the sense of a tertiary market. I think a lot of people have a hard time understanding the value that these small markets provide to people. So what we're going to really be focusing on is sort of one, finding and assessing the right deal for yourself, and two, making sure that it's going to generate the most amount of rent. So without any further ado, we're going to go ahead and get started. And at any point, if you have any questions, feel free to go ahead and let Garrett know, or just by typing in the chat here, so he can answer anything you guys may have. All right, so here, automatically, we're going to kind of start with a few different things, but ideally, the first thing that we're really going to try to do is identify the right market. And by doing that, that means we need to understand what type of markets are out there. So for one, we have our markets that are, for example, like our tertiary, our secondary, and our primary markets. Those primary markets are going to be, those large, really big cities, right? They're going to be huge. They're going to have a huge population, and they're going to have a large booming economy. And it's already taken care of. We're gonna have a large economy it's already taken care of. In these markets, a lot of the investors that we work with and a lot of the people that we work with and come across are expecting other people to do the majority of the work for them, as in you're already building your property or buying your property next to someplace popular or fun or the best work destination, because that work has already been done for you by the other investors, by the other developers, which makes them such great targets for people who want to make huge returns primarily on things like flips, right? So most people go to these markets and flips. For the most part, a lot of people will want to do rentals, and that's okay. What we do see a lot of is, oh, can you guys not see anything? I apologize. So yeah, they got large economies, lots of flips, lots of rentals. And then the other thing that a lot of people really try to capitalize on is appreciation. It's not coming out. Oh, that's all you had to say, man. Don't know why it's not coming up. Give me 1 second here, guys. Can you see it now? Solid. Sorry about that, guys. So as I was pointing out, large economies for a lot of people to really take advantage of, especially in the real estate market. Again, lots of opportunities for flips and rentals. And of course, the large one that a lot of people want is that appreciation. And so what happens with this appreciation is you don't need to be the only person in this market. You're relying on all the other homeowners, all the other investors. You're relying on this large economy, right? This economy of skill to feed your appreciation in these primary markets. It makes them prime, solitary markets where people can just boom. The only thing that's really negative about them is that their economies are tied to a bunch of different industries. Usually sort of one industry is that's how most cities and governments attract business, is by loosening laws and restrictions to really bring in one form of business, whether it's tech, whether it's construction, whether it's oil and gas. So the other thing you really want to find, especially in a market like this, is something that you can diversify. Well, forgive me here. I'm new to the whole screen thing. So the diversification process of this is identifying a market that has everything that you could possibly need, from a large section of non-gentrified neighborhoods to a growing group of people who are going to be moving to these areas. And that's some of the things that you really just need to pay attention to. Moving on to our secondary markets. Our secondary markets are going to be the ones that lie just outside of a tertiary market. So for example, while a tertiary market may be here, a secondary market is out here. And this is where a lot of people are really going to be able to find the majority of their value. Secondary markets have a lot of distressed homes. I'll write that up here for you. Distressed homes. They have a lot of distressed homes. Man, that is just bad. It's awful. Let me rewrite that, guys. I apologize. They have a lot of distressed homes. And with that, lower pricing. But it's not super low than what you would find in a primary market. So lower pricing. This pricing is going to be determined on where the primary market itself sits. So I use Dallas as a prime example. Our secondary markets are markets like Frisco, McKinney. These are markets that sit far beyond and well off. But the thing that makes them secondary markets is that their economies are wholly dependent upon Dallas for people commuting back and forth. So with a secondary market, they rely heavily on everything that happens here to come right back into the secondary market. They rely on people to commute. Generally known as the suburbs, that's what the secondary market will generally look like. Your tertiary market, my favorite, number one, right here. Your tertiary markets are going to be the markets that sit outside both your secondary and your primary markets. They have properties that, instead of looking like this for your primary, this for your secondary, they look like this for your tertiary markets. They don't have a lot of economic growth, very small populations, no more than 100,000 people, if not, just a little bit more than that. Lots and lots and lots of distressed properties with very little development, with very little economic gain coming into them. Those markets are tricky if you know how to do them correctly. Luckily, Reunion is something that we focus on primarily because these markets offer so much of a reward to our investors if done correctly. So when going through these markets, the questions you generally need to start asking yourself, and always ask these questions no matter what kind of market you're going into, is what does the market need? Does the market need more? Does it need rentals, right? Does it need flips? Does it need short-term housing, right? Airbnbs, hotels, whatever it is. These are the things you need to start asking yourself when you go into a market. And really, that really comes down into how you can really understand how these markets work. The other question you need to ask is who's driving the demand? Is it the renters, the landlords, the buyers, the sellers? Is it the new companies coming in? Who's driving demand for the new thing that you're thinking about building in this market? At this point, when you're IDing your markets, all you're thinking is, what is going to be the best avenue for me to achieve what I'm looking for? And the last part here is, how do you benefit? You as the investors need to understand that there is going to be a benefit analysis where you have to identify what's the cost of this and where am I going to make my return. And if you don't factor in a lot of things, you are going to miss out on the majority of your money, whether that's taxes, right? Property taxes in Texas are notoriously high for people who aren't used to living here. And especially owning a property, that does take away from some of your return. Owning things like apartment complexes, right? Your turnover rates. Well, if you have a market that's just constantly bringing in people, the thing you need to realize is as many people come in are as many people as you're going to have move out. As we start going and building and designing these new neighborhoods and these new areas and these new communities, we are pushing a lot of people who we could utilize originally for cheap labor to, cheap help to whatever it is, are no longer there. So things go through the roof and that takes away from where you benefit. That's what you need to realize there, right? So coming in here, the thing you need to do is verify your questions, all right? Talking with the locals is always one of the best ways to do that. They are going to chat. The questions that I generally ask are, what is needed here, right? That's always the first question that I ask whenever I go to a market like this or any market. What is needed here? And in the form of that question, they'll usually tell me, it's all about understanding the context of what they're telling you. They may say that they may want a Dairy Queen or a Whataburger. What they're asking for is a commercial building that serves food that provides jobs to people. That's what they're asking for. So you definitely need to understand the context in which these people are asking certain questions and the way that they answer the certain questions. One thing that I've gotten really good about doing is I will send out neighborhood surveys in conjunction with the city officials here. I'm kind of the second portion of this. Those neighborhood surveys will allow us to figure out exactly what's needed in each neighborhood so I can build exactly what's needed. Therefore, I don't need to play the guessing game with my money or my investors' money. I already know what needs to be put in place. So that's always the other one. With the cities, it's more of a question of what will boost your economy. Most of the time, cities will have an answer to this question. Sometimes they don't. If you break it down from tertiary to primary or from primary to tertiary, primary markets are going to understand their needs a lot more because they've already encouraged a lot of their need growth. Secondary markets are going to look for more people, but be very selective of who they bring in. A tertiary market is willing to bring in just about anybody. Sorry about that. Is willing to bring in just about anybody to make sure that they can boost their economy. So it's going to be one of those things where you have some control over what you can bring in by, one, analyzing the trend and asking the locals. Two, going into a secondary market and identifying with the community and the locals. And three, going in and identifying with the community at the, going in and identifying with the city and the city officials at the tertiary market. And that's exactly what Reunion does. Our biggest focus is working with local governments and federal governments to provide the best possible form of service and provide the best possible form of investment to our investors. So some ways you can kind of figure out what these markets need. You can drive around the market. A big thing I like to do, I'll drive around the market and I'll drive around the worst neighborhoods and just kind of see what people are doing. If I see a lot of people out in the middle of the day, that lets me know that unemployment's going to be high. In a tertiary market, that's generally the best case. In a secondary market, same case as well, but you can automatically assume in a secondary market that someone is already going to be coming in with a plan to develop. With a primary market, there are not as many of these. You will see a lot of poverty, but not like you would see in the other two markets. So what you'll see is, a lot of government assisted poverty in primary and secondary markets. Tertiary markets, not nearly as much. Once you understand the market a little bit better, right? You need to do one of two. You need to do one of three things. Well, you need to do all three. We'll say you need to do all three, right? You need to plan a 2 to 5 year test phase. Basically asking yourself, right? Every 2 years, I am going to do ... So the way that Reunion does this is we plan. We plan with our investors, we plan with ourselves, and we plan with the cities. And we say every 2 years, every 5 years, every 3 years, we're going to flip 4 homes. We're going to flip 3 rehabs. We're going to build 6 homes. The reason you're doing this is because down the line, what you really want to focus on is something very simple in the real estate community that a lot of us have definitely forgotten. And I'm going to explain it right here, right now. Something that, again, Reunion itself and my company have built a very good job of is identifying. So let's say you buy up this house, and this house. And every 3 years, you sell homes. So you sell all 3 of these homes for just around the same price. Enough for everybody to afford, but enough for you to make a profit. Now, these are all of your comps in this market, which means when you fix up these other 3 homes, you can raise your pricing because you now know what the market's going to pay for. You know what you can make better. You know what you can make more expensive. You know what you can make on each property. So now that you've bought these properties, again, right, every 3 years you come in here and you sell these homes. So that's why you want to have that plan and a strategy going into these markets of every X amount of years, I want to do Y. Oh, I'm sorry about that, guys. Yeah. So that'll make it a little bit easier for everybody going in, because if you can follow that strategy, it's going to make sure that there is a plan, and you can definitely make those plans known to the community, the city, whatever it is. But it's going to establish those comps for you as you move forward. And having a plan, having a strategy in one area instead of 100 different areas is always better, because this will give you more control over the way the market corrects itself and the way that the market does anything. Because these other investors who are going to come in here are going to benefit the same way you are, but they're going to benefit from your hard work. So this is what I mean in these primary and secondary markets. All of this work is generally done. Very difficult in a primary and secondary market to buy up all of these properties in the exact same format, especially for the right price, fix them up and be able to sell them for a profit. Tertiary markets is a lot easier to do this. And in a tertiary and secondary market, the next person comes and they benefit from your hard work. But every time they sell their 2 homes, you are going to benefit from their homes. So now that they've sold their homes, you can go and buy the next couple of homes later down the road, or maybe the same month, or maybe the same week, depending on how you're feeling. And now you can start the process over again, literally within the same little neighborhood area that lies within. So this is a way that you can transform your entire portfolio and create a lot of value for the people around you, while also making a lot of money in the process, if that makes any sense. So coming in here, let's see. So yeah, every couple of years I'm going to do what? So now we come down to, where can I supply the most value? And that's one of the other things that comes into this is, does this market, and from our last question, right, does it need single family? Does it need multifamily? Does it need commercial? What does this market need that you can provide? And honestly, that comes down to a lot of different things. My best bet is you do a nice analytical research deep dive into the market, or you hire someone to do it, and they can tell you everything that that market is going to possibly want and be able to hold and sustain. Sustainability is key, because if you start going and building $1 million homes in a neighborhood where homes usually cost 35 grand, you're going to see some problems. So it is always smart to make sure that, again, your plan makes sense relative to the market and what you're looking to do in that market. So again, we're looking at where can I provide the most value. We're going to look into things like single family, multifamily, and commercial. Now, a brief example of this is how Reunion takes care of its markets. We will identify an area, and if we run into an issue or we can identify the same issue that most people have, we can solve for the problem, which in my case is X. So let's say we've got, somebody here. OP stands for an elderly person. Well, I guess it stands for old person. I apologize for that. Let me just, boom. So yeah, we're gonna have our elderly persons here, our elderly persons here, our elderly persons here, and our elderly persons here. That's 4 elderly people in one area in one neighborhood. So if you can identify that and say, well, I really want these homes, but I don't know how to get them at the price that I really need. So the reason why is because these elderly people are trying to sell their homes to be able to afford something better. And if you offer them dirt cheap, they're not going to be able to do that. Therefore, they're going to hold out. Therefore, they're not going to be able to sell to you. So the best bet that you could possibly do is, if you have friends or if you know somebody or if you work with a company like Reunion, identify the problem and say, hey, I would love to get these homes, but there are all these old people. I need to build a senior care facility. Because most problems that you're going to run into, especially in areas where you want to buy properties really cheap, this is the problem across every single market, all across America. The elderly are now getting to the point where they cannot take care of themselves and their homes, and they need a place to take care of them. There are not enough senior care facilities in America. There just aren't, which benefits you, the investor, because now you get to build them. And when you say, hey, Ms. Johnson, if you sell me your home, I'll give you this first year in the senior care facility for free. Same thing to every single one of them. And now you've been able to offer up these homes for a lot cheaper. So now you've gotten these homes at a phenomenal price. And now you can rehab and start doing your plan. So that's, again, right, planning for the areas and scenarios that are going to happen that you need to make sure that you understand, right? If you can understand that there are a lot of elderly people in the market, then going after that and identifying that and building quality care for them is going to be the best move, because it frees up the entire market to do everything that you need. All right. So after that, you can start looking at properties. Looking at properties is going to be sort of your last step, right? Because you don't know where you're going to be able to kind of put anything else at the moment until you identify what your plan is going to be. Once you identify your plan, then you'll be able to identify the market. Therefore, you'll be able to identify your properties. So with our subject property, I've actually broken it down for you. So very simple. We're going to go in between screens here. Boom. So the property that we're going to be referring to first will be 1904 Minnetasca. This property is in Wichita Falls, Texas. Again, one of our primary markets. And when we first got into it, right, it was just a little run-of-the-mill property, but here it is in relation to the city, right? It is, I'll let this load. It's about 5 minutes away from the university and about 10 minutes away from the military base, which means I know that I can fit either students in here or I can fit military members in here. For Reunion, we cater to everybody. So military, regular people, civilians, students, it doesn't really matter to us, as long as they can, 1, afford the rent, and 2, not go into financial jeopardy because they're paying their rent. So this is the property here. It's not very large. And the first question you got to ask yourself is sort of, what are you trying to get into? My suggestion is start with something small. It's a nice, small little property that yields a lot of people a lot of money. Well, one person a lot of money, but this is what it looked like before we purchased it. Grass was high. It had this nice little shed back here. This nice little shed back here. I'll wait for everything to load. And that may not happen. So in general, if you can see my screen this way, the home was a mess. Siding was just in complete disrepair. windows broken, some garage conversion they made. And it just wasn't a solid looking property. If I could show you the inside, I would 100% do it. There we go. So with this property, some of the issues that you run into in these smaller markets, at least in a tertiary market. So Wichita Falls being a tertiary city, a lot of its properties are old. We're talking 1960s and newer-ish, but for the most part, a lot of them are going to be relatively old homes. We have to identify how we can make the most value out of this home. Luckily, this was not the nicest home on the block, so we knew what we needed to go off of in order to achieve those comps. And so what we did was we took what it was a terrible garage conversion and we made it into a large master bed. We added HVAC, we added electrical. We offered everything that you could possibly need for this property. That's not going to load. So once we got all that taken care of, we built up this home and had to redo the plumbing, add a new bathroom. It took a lot for us to be able to do. And so it took a lot of work. So we were about $35,000 purchase price and, no, I'm sorry, about $40,000 purchase price and $55,000 into the property. And I wish I could show you guys. So there we go, listing photos, perfect. So this isn't what we ended up doing, right? We took the entire interior of this property and we redid everything besides the cabinets. We put down completely new flooring. We reset all the windows that we had originally in there because some of them were good, but not all of them. So we replaced what we could replace. We replaced the doors, replaced all of the drywall and just re-sheetrocked everything, brand new countertops, brand new sink, brand new hot water heater. We ended up keeping the same bathroom tile. We kind of cleaned it up a little bit more, but we completely had to replace all the bathroom. In the front, right, we had, if you could see the video, we had this huge plank of the foundation coming up, this huge beam coming up through the floor. So we did have to do a lot of foundation work to this property in order to get it going. The best part about these homes in this age of these tertiary markets is that they are majority all pier and beam, which gives you a huge benefit of making sure that you don't ever have to really dig up a large concrete foundation. So the cost is very minimal. It is still expensive, but it's not nearly as expensive as what it could be. So this is not going to be loading for us, which is a-okay. So we're going to come back to the actual deal analysis, which comes down to here, right? We ended up spending $30,000. I was right, $30,000 to purchase this property. Wasn't a bad price, but $10,000 a room. We fixed it up for about $45,000. That includes new roof, new plumbing, electrical, and redoing all the drywall and the sheetrock and the paint. Finding a contractor in tertiary and secondary markets is a little more difficult than finding them in a primary market. There's a lot more construction going on, so contractors tend to be where most of the jobs are. In the in the secondary and tertiary markets, that's not so the case. Reunion does have its own construction company. We do take care of rehabs, new builds, everything you could possibly want, commercial from single family down. So the question we also had to ask ourselves moving forward on this lot was, do we maximize the lot space or minimize the risk? For this investor, it was their first property, so we minimized the risk. What I mean by maximize lot size or minimize risk is very simply, do we tear down this property and build townhomes? And that is something that we have really started to do a lot more of in this market as we are trying to compete with how many people are moving here on a daily basis to be able to keep up and maximize the investment as best as possible. But regardless, we ended up going with the rehab model. And in exchange for that, we ended up getting the monthly rental rate of $11,150 a month, minus a 10% property management fee and the $100 in property taxes every month and the $300 mortgage. The profit every single month is $635. The after repair value, when we first started building the home about 3 years ago, when we first started everything, was a little bit under 80,000. Now it's about 110,000 because just like this property, just like this example, we went to multiple different areas and we started buying up properties around the same price because we already knew what the next home would sell for. There was already a home that had sold in that area. So I had already known what we needed to do. So while this home was call it our starter home, these other homes were the next in line homes, right? All the homes we needed to sell in order to boost our price. So this one being, 1, 2, 3, and 4, as Minnetasca appraised for about 79K, the next homes would appraise for 80K, 85K. Oh, I'm sorry, 85K. And then this last home being able to sell because we sold it in a different time. So with this investor, it was very simple. Every 2 years, I'm going to sell 3 homes. 3 homes being sold. We didn't end up selling Minnetasca, but we ended up selling the 3 after that. And so we were able to sell that third home for $100,000. And the reason being because these other 2 homes sold, but I wasn't accounting for how other people were selling their homes in that market. And so when it came, we got this very happy surprise 3 years down the road of a huge sale coming in. So moving into the sort of the return and investment amount, I don't know that a lot of people can really say that they get so much profit from a property in any tertiary or secondary market because of things like property taxes, because of things like mortgage payments. These are all things that are really going to highly affect how you invest in each market. The return rate on this property, I believe, is about, give me 1 second to calculate that. It's about an 18% return, give or take. So that's not terrible for a property, especially in a tertiary market. To be able to get that every single month and be able to sustain that is very easy. The reason we can sustain these properties is because luckily we're one of the only few companies out here really pushing this kind of product to people. And when I see this kind of product, I mean this sort of mid-tier luxury sort of home, something that you would see in what would be maybe a D, I'm sorry, not a D, a B or a C class property here in Dallas. And those are the kind of things that we can really get moving because it's going to be the nicest thing there. Again, if you see the properties from before, or you see the pictures from before, this property really didn't have that much of a fighting chance. It just didn't look good. It really didn't. And we had to really do a lot of work and really make sure we, crossed our T's and dotted our I's to make sure that this property was going to be able to do what we needed it to do. And so after 4 months of total time on construction, we were able to get the property up and running. I think within the first 2 weeks of it being on the MLS and the military MLS, it got rented. So we didn't have to wait terribly long. And from there, it's been rented for 4 years straight. And that's been one of the best parts about, building out a company like we have. Now, with all that, it's a matter of understanding what the exit's going to be, and building that exit after you get a property like this is key. Not everybody wants to hold on to a property forever. Some people do. But if you build that strategy around how you're going to invest in this market and how you understand how this plays into this and how all of this fits into the bigger picture of I must strategize, plan, and every 2 to 5 years, I must either sell, buy, rent, or sell, right? Those are the only things that you can do every single time that you need to do to keep your values moving. Tertiary markets do not encourage a lot of selling of properties. They encourage a lot of rentals. The more you sell, the higher the values go. The higher the values go, the more profit you can make on the back end. Because our properties are so cheap at $30,000, you could essentially buy 15 of these things and sell them off in phases, phase 1, phase 2, phase 3, while still making great rental income. And then you just keep reinvesting those profits back into that market. So they are great 1031 exchange markets for the main reason that you can hold them for 5, 6, 15 years and sell them off and literally replace that cash back into the same market for a higher value property that you can get more equity in. So essentially, that is the conclusion. Does anybody have any questions? Let's take them. Awesome. Cool. Well, everybody, I truly appreciate you all joining. If you do have any questions for me, let me know. Our email address is reunion@hirec.com. Garrett will put that in the notes for you. You can also reach us on our website, Reunion Investments LLC.com. You can also give us a call at 214-438-4809. My extension is extension 0. And yeah, we'd love to see you guys and speak with you guys more. If you like what you saw, it will be on YouTube by the end of the week. And you can see the rest of our content all over YouTube as soon as possible. What can I help you with?
June would like to know if you could show her what opportunities you have available right now.
I can show you some opportunities 100%. If you would like me to shoot you an email, I can send everything to you, June. And my email is Solomon, SOLOMON, @hirec.com, HIGHERC.com. But for the most part, the majority of our opportunities that we have available are going to be rehabs, and they are also going to be new builds. Again, we are getting properties really cheap. So for us to be able to just knock them down and really maximize these lots gives us the ability to bring in a lot more people. Our new build cost right now, we're building 1,500 square foot homes to 1,800 square foot homes for about $110 a square foot. We are selling them from anywhere from $135 a square foot to $155 a square foot, depending on finish out and size. But other than that, those are the biggest opportunities we have available, because again, a lot of these lots are on 10, 15,000 square foot lots. It gives us a lot of room to build a lot of housing and provide good with the ability to bring on way more income for ourselves than we would in any other market. Oh, I see. All right. Well, if you guys actually want to sync up after this, we can do another video call where I can kind of go through everything as well. So that way it makes a little bit more sense. But yeah, I really appreciate you guys being on here. If anybody has any questions, feel free to reach out to us. Really appreciate you guys being here. Thank you.